All right, everyone. Thank you so much for joining us for the next session of the Founder University Series of Nevada. This session is fundraising types and outreach to investors, and this is the first in our series on the capital raising portion of this series, which is, of course, where many of you are here to find as one of those really highly anticipated sections. So we're really excited, and we're really excited to hear from the man himself, Jeff Saling, who's the executive director and co-founder of Startup NV. Many of you know who Jeff is, but I'm going to go ahead and give Jeff a warm intro. Jeff is a serial entrepreneur with successful exits that include 3 IPOs and 1 private sale. As a business founder, executive, and strategic advisor, he has a deep expertise in software, especially software as a service, or SaaS, and cloud-based systems. After years of launching, running, and investing in successful startups, Jeff has turned to focus on expanding the business community in his home state of Nevada. His 501(c) nonprofit, as you all know, Startup NV, is dedicated to building a vibrant startup ecosystem to help to grow Nevada's local economies and diversify Nevada's workforce. Jeff has also recently led, well, not recently, for some time now, led bipartisan support at the state and local level for entrepreneur and business-friendly policies and legislation, which we're very excited about. Thank you guys for joining us. And without further ado, Jeff, everyone of you mostly knows who you are. I'll just pass it over to you.
Thanks, Logan. Really appreciate it. So as Logan introduced, all the stuff he just said is like right here on that slide. All of the startups that I've been involved with since 1992, starting with 1-800 Search, the first one after college. And one thing I will comment on, I have 2 pictures on the slide here. One is me and my friend Bernie Brenner, who helped, we co-founded 1-800 Search. So there's our pictures in 1992 and our pictures in 2022. So there's a few miles on us. So this is not this is a business that does take a little bit of toll on you. So, I've been through the companies that you see in green there are all 3 companies that went public and all eventually got acquired by private equity and or much larger companies. And so been down the capital raising road a few times here. And since 2017, I've been working at Startup NV, have formed up Fund NV, Angel NV, 1864, with a lot of help from a bunch of folks. And then I also teach a class at UNR, Engineering 461, High Tech Entrepreneurship, and am co-president of the Sierra Angels with Maggie. So, and as Logan said, I'm going to stop for just a second on the lobbyist point, because if everybody here is in Nevada, we just passed a new law this year called AB 75. It's called the Nevada Certified Investor. And what it allows us to do in Nevada is if investors are in Nevada, Nevadans, and the company is in Nevada, the standard for raising capital from those companies, from those investors has been lowered. Used to be you had to be an accredited investor, which meant you had to have $200,000 a year in earnings or $1 million of net worth outside your principal residence. The standard in Nevada for intrastate investing is now if the investor earns $100,000 a year or more, or has a business that grosses, not nets, but grosses $200,000 a year or more, they can invest in private companies where they don't have any relationship to the founder. We're getting all of the rules and regulations sorted out right now with the Secretary of State. It should go into effect. Well, it's been passed and signed into law. There's a couple of months now where the Secretary of State's working on, making sure that the regulations are clear for people to follow. So that should be done by October 1st. So you hear more about that as time goes on, and it does open up a new avenue for both investors to invest in these awesome startups that are coming through the program, but also for founders to raise capital from Nevada certified investors and not just accredited investors. From a percentage perspective, under the accredited investor standard, somewhere between 3.5% and 4% of Nevadans meet that standard and can be investors. Under the Nevada Certified Investor Standard, we don't know exactly, but we think it's right around 30%. So a big jump, about almost a 10x jump in the number of people who can be an investor. So this is me. This is who's yakking at you today. As we go through and talk about the main topic here, please, raise your hand if you're in the room, message through the chat, and Logan will signal me or throw something at me to get me to stop and answer questions. So at the highest level, this is how I think about the journey of an entrepreneur and how it interfaces with raising capital. The earliest stages, the feasibility stages, when you're thinking of your idea, you're validating your concept, you're developing your product or service, and you're going into a beta, pre-revenue, right? You're not making any money. This is probably the hardest stage at which to raise any capital. The most common sources of capital here are your own founders, friends and family, which luckily many of us have friends and family that will invest in us. It's a minority of us that actually have a position that have friends and family that could invest in you. And then there's debt. You can go out, get a loan from a bank. The banks typically will want you to have some kind of collateral, or I shouldn't say typically, almost always want you to have some kind of collateral. So usually they'll let you borrow money if you're willing to put your house up or some other significant asset up, which is risky. So you have to decide whether or not that's something you want to do. A lot of people do. Credit cards, a lot of people will just run up their credit card bill in order to finance their basic living expenses while they're getting their business started. It seems like it's an expensive way to do it, and it's certainly risky because you're not personally liable for that debt unless you're dealing in one of the very few exceptions to that. And so if your business doesn't work out, you're still on the hook for it. And that's an individual decision to make. I can tell you right now that debt, by and large, is a much less lower cost way to raise capital for your business as opposed to giving away chunks of your company. But you have to make the decision whether or not you're willing to put your personal assets on the line to raise that debt and do that. So there's many opportunities around for you to go raise money through SBA loans, through second mortgages, through leveraging your stock portfolio. There's a bunch of different ways that you can get debt and raise capital. Now, debt's more expensive now than it's been in a decade. So the interest rates used to be very low. Now they're still pretty low, but it is more expensive now than it was before. And then there's a lot of people that say, grants, can I get a grant? And some people are eligible for a grant. If you've got a solution that's got sort of a government or particularly a military application, there are grant programs, the SBIR and STTR, the SBIR grants especially, are things that you should learn something about. It's not easy to get a grant. It's usually reasonably easy to get the first phase of an SBIR grant if you can demonstrate some reasonable expectation that somebody in the government might want whatever it is that you're doing. But for your everyday commercial apps, the chances of getting a grant, pretty low. We have one company in our group called CID. They provide asset tracking equipment. They put these little Bluetooth tags on everything and have a mesh network for tracking stuff, mostly in really large yards. I saw a lot of times they'll call it yard management. And this has a big application for the military. They want to track, where all their assets are on a base, including bombs and bullets and other things that really ought to be tracked at every moment of time. So they have a military application. It's not easy, but they're in a place where getting a grant is a reasonable thing to expect. Any of these businesses that I worked on that you see back here, none of them would ever be appropriate for a grant because they're enterprise software businesses that are back office work for the big companies. Not going to get a grant for those kinds of things. And by and large, most companies don't get grant funding. But I didn't want to go on with the rest of it until I covered at least those first two things before getting in sort of the guts of angel capital, pre-seed, and the rest. And you can see on this chart, what the money is usually used for at this stage. Whether the founder's funding it, the friends and family, whether you do go into debt or you get grants, usually it's getting your company established, doing your initial research, figuring out what your market is, building your prototypes if you're actually building a physical thing or you're producing some software, getting those very first things out so that you can get whatever your idea is out in the market and sort of get some proof of life, get some some indication to investors that will follow that this thing that I've created has value to people who will pay me for it over time. And you can see the sort of the timelines that are generally expected for this phase of operations. And these are additive timelines, right? So it's 90 days plus another 90 days plus another 120 days. So, you're talking about not quite a year, more than 3 or 4 months, but less than a year to get through this sort of pre-revenue part where you're getting to the point where you can actually go out and at least start considering raising money from outsiders. Along the bottom of the graph, you see some of the programs that Startup NV has to help founders in these various stages. So Incubate Vegas is a incubation program that's aimed at founders who have ideas and help to get yourself organized around on getting your ideas to the point where you can raise capital for it. And then you get into the other Startup NV programs, Startup NV, Incubate NV, which are a little bit further along. And then the Founder University is really targeting folks who are a little bit further in the journey that are probably at the place where they can raise capital, but not necessarily at that place where they can raise capital. So in those early stages, these are the things that you have. As you get into the later stages, as you start to bring your company to market, and you actually start to be able to charge customers money, and they sign contracts and they pay for these things. Now we're talking about getting into pre-seed and angel financing, on into seed financing, larger angel groups, and then finally into the A round funds. The kinds of things that those funds are typically used for at the earliest stages is running your initial marketing experiments, trying to figure out whether or not the way you think you're going to go to market is going to work, making the necessary pivots, and refining the products. You're going to go out with some kind of beta. It's probably going to need some changes made to it, but those initial funds are really focused on getting a real beachhead. The next set of funds are aimed at growing from that beachhead, and refining the marketing and really starting to grow your sales so you can get into the larger rounds of funding in seed and A rounds. So I'm going to go to the next slide that's going to talk about these different rounds, about how big they are in terms of the market. And then we'll move on to, so how do I get in touch with these people? What do I do? And I'm going to just take a breath, see if there's any questions.
I think people are still just digesting it. You're good for now.
Okay. All right. So there's a lot of terminology out here about where these rounds are, how much money actually comes from these different types of investors, and so you can start to get your mind around, well, where does my next round likely come from? How does it work? How does it fit in the grand scheme of things? And a lot of it has to do with how much you're raising. So the fact that the one we know the least about are the top two, self-funded and friends and family, because they're not really tracked anywhere. I mean, we have a general idea in the marketplace, just from people self-reporting about how much money is in there. We know that a lot of money is used by founders to fund their own company. Some of them can only put in a few $1,000s. Other people that may have had an exit put millions of dollars into their company before they seek outside investment. So that range is quite big, and the investment tranches are also quite varied in that range. Friends and family, you can usually rely on your friends and family if they are people of means to put $5,000 to $25,000 in a round in your company. Sometimes people are lucky and they get bigger, but the estimated market size for that group in the overall startup economy is about $50 million a year. These numbers are as of 2021, although I've done a little bit of tracking on research to see where we ended in 2022. You see those numbers as we get further down the list here. Incubators and accelerators. The programs like Startup NV and the related funds to Fund NV generally make investments of between $0 and $250,000. Not all incubation and acceleration programs actually provide funding. Some of them just provide the education. That's certainly how our group started back in 2017. It wasn't until 2020, 2021 when we actually had a fund that we could invest in. Our current investments are $50,000. That's matched by the state for $100,000 when we make an investment. And if we can add on to our 50, say we get a bunch of other investors to throw in an extra, $75,000, then the state matches our entire investment. So that $125,000 turns into $250,000. And as far as an incubator or accelerator program goes, that's large, that's big. Most of them are $50,000 to $100,000. And we'll get into those numbers and the types of investments those are in the next slide. Then you have angels and angel groups, and those angels and individual angels, angel groups, pre-seed funds, and seed funds generally will make investments between $100,000 and $3 million. As you kind of move down the continuum there from angel to angel groups to pre-seed fund to seed funds, that number goes higher toward the 3 million. When you're at the beginning of that, it's closer to the 100,000. About $25 billion a year on average is funded by this group of investors. It's a pretty significant, and it's a primary way that founders raise capital to get through what they call the valley of death. Before you really have product market fit, before you can really demonstrate with a great deal of confidence that what you've built is going to have a large market. And then you could generate, investments in that, $5 to $20 million range. So it's key for most people to try to figure out this angel group, pre-seed and seed fund thing. And we're going to spend a little bit of time on that in the next slide, because that's really the critical piece when you're in the very early stages of raising money. Finding individual angels is difficult. Angel groups are a little easier to find, and I'll give you some resources on how to look them up. Pre-seed fund and seed funds, again, even a little easier to find if you use some of the resources I'm gonna give to you here on the next slide. And so finding these folks, finding who fits with you is really going to be the key to getting some traction, and at least being able to get in front of these groups to share your idea. There was a lot of excitement back in 2012 when Reg CF came out. Everybody thought this is going to do it. This is going to solve the problem for early stage funding. And it's an interesting market. It conflicts a little bit with the angels and angel groups and the A-round people, because most of us who are doing any of these other things, we won't touch a company that's in a current Reg CF raise. There's a lot of rules and regulations that you have to follow when you're in a crowdfunding raise that are not compatible with angels, angel groups, pre-seed funds, and venture capital in general, mostly because of the public disclosure laws. And once you've started a Reg CF raise, you cannot share any information that you don't share with the entire community. It's almost like being public. And venture capitalists and angel investors and seed investors, they want to know a lot of stuff that's not necessarily in your Reg CF information packet that's out there on one of those platforms. So we've had to turn down interesting companies where it was like, I'd like to know more, but I know you can't tell me. So when you're done with that Reg CF raise, let me know, and maybe we'll consider it. So Reg CF, it showed a lot of promise at first. Generally speaking, if you have a consumer-facing product, a tangible product that consumers will buy and they can understand, you stand a chance on a Reg CF, one of the Reg CF platforms. Now they'll give you lots of examples about no, this software as a service, back office software product, raise some money. Those are the exceptions. The most of the time, if you've got a consumer-facing product, the people that are on the Reg CF platform and making those investments, if they can understand it and they can visualize themselves going somewhere and buying it, or I think there've been a lot of success with whiskey brands and beer brewing places and things like that. Things that consumers can go out and consume. If you've got one of those things, then check out the Reg CF stuff. It might be more appealing to you than some of the other things that we're going to talk about. Two of the big ones are Start Engine and WeFunder. There's at least a half a dozen of them out there that have a pretty good workflow for you to get through to get to the point where you can raise money. It's not free. It will cost you usually at least 10% of whatever you raise is going to go back to the platform that you're on. And there's some fees, there's a percentage, and it usually adds up to about 10% of whatever it is that you're raising. And there's minimums. You have to go out and hire an accountant to make sure that your books are in shape so that you can go out on the platform. So if you're going to go that route, just be prepared to spend $10,000 to $50,000 to get your offering ready to go. And then you should have probably at least 10,000 emails that you've collected over time where people are interested in whatever it is that you're doing. These are separate emails. And then you should have another 10,000 followers on Facebook, LinkedIn, Twitter, and YouTube to make sure that you've got enough of an audience so that when you launch that thing, you'll have enough interest in it that's going to raise a reasonable amount of money. Reg CF, the stats are it goes from 10,000 to $1 million. $10,000. I don't know why it wouldn't really be worth the effort or the money to raise just 10,000. It cost you more than $10,000. So these are generally in the $100,000 to $1 million range. And it is good for some folks. It's not really in the world that I work in too much, but it does work for some folks. Now now we get into the big rounds, venture capital. Series A is sort of Series A used to be everything. I mean, before we had pre-seed and seed, Series A went all the way back to what the angel groups had. But the venture capital firms got so big, they had so much money to deploy that they really couldn't write checks for less than $5 million and be able to actually deploy their fund in the time that they promised their investors. So these other round sizes, pre-seed and seed, came into being. And venture capital mainly focuses in that $5 to $20 million mark. There's about $70 billion worth of capital that gets deployed on an average year out there. 2022 was difficult. There was about a 35% less capital than average deployed in 2022. 2023 so far is slightly better than 2022, but not much. The tables where the founders have sort of ruled things for the past 10 years have turned. There is a lot less capital out there in these venture funds that is being deployed as readily as it was 2021 and earlier. But if you're raising, if you've got it like $1 million to $2 million in revenue, and you're raising between $5 and $20 million, and are willing to give up about 20% of your company, then you should. That's about where things fall in the A round. So again, you're raising $5 million to $20 million. So think about, okay, I'm raising 5 on a $25 million valuation, right? You should have at least $1 million in revenue. And if they're going to give you a $25 million valuation, you're probably going to need to have more than $1 million a year in revenue. So we're going to talk about valuations when we get to the question and answer period. So then you get into the really big rounds, which are probably a little bit off topic for today. For the B rounds, the C rounds, and all the rest. Those are much larger rounds, which is why you see that the numbers here are so big, right? The round sizes are 30 million to $2 billion. They can even be bigger than $2 billion as you get in to the later rounds. There's $600 billion a year invested in these rounds. So it's one of the biggest areas for venture capital. These are companies that are pretty mature. The venture capitalists in those ranges still view that they're taking huge risks and that they're part of starting that company up. But for those of us who are earlier in the cycle, we say, you guys are taking a risk? What are you talking about? These are companies that have been around for years. They usually have millions and millions of dollars in sales, and they're raising really large rounds to really go to market with it in the hopes of probably getting to an IPO or at least an acquisition that's sort of in the unicorn area. Then we get into the really big stuff, IPOs. IPOs, the bottom end of the range is $75 million. There's not a lot of companies that are doing a $75 million raise for an IPO, not in 2023. That stat was true probably 10 years ago. But most of the ones that are going into an IPO are expecting to raise at least $500 million on a much larger valuation. It's not even as big that, again, the IPO market is not as big as the total venture capital market put together, but it does punch above its weight. It's a public company. It's where everybody gets cashed out. It's You know, a lot of people think of it as the finish line. It's another starting line once you get to an IPO. And then there's the private equity and acquisition market. It's huge, huge, absolutely huge. It can go as small as $10 million to buy your company. And that's a really nice place for companies that have maybe raised at pre-seed and seed, and they're thinking about maybe going to an A. A lot of times you should be really thinking hard about trying to be acquired at that point, because the journey ahead of you, once you've raised A round capital from a venture capitalist, is pretty difficult. That's why Bernie and I, on that picture in the first slide, look a lot older now, because we've both been through that journey a few times. But if you can get to the acquisition market, you know, as you're in the pre-seed or probably in the seed level, as you're thinking about what am I going to do next, that's when you would start thinking about looking into that acquisition market, whether it's with private equity or with just a larger firm. But almost all the companies that I had success with that we got all the way to an IPO, eventually a private equity firm would come and buy us, and with the hope that they would be able to trim out a lot of costs, get it more profitable, and then either sell it to a big company or maybe take it back public again. But that's where there's a lot of money that's made by venture capitalists in that private equity market. It's pretty brutal too. A lot of people get squashed down. A lot of tears are shed when you are in a weak position and private equity comes knocking at the door. So, what are some resources? Where can you go find some of these investors, and how do you need to approach them? So down the left-hand side of the slide, you see some places to go look. Crunchbase is a real favorite of mine, especially when you're in the early days, and especially because there's some free tiers in there where you can get a lot of information. But don't be too cheap, because even the first level of Crunchbase, I think, is only a few $100 a year. There's a ton of information in there about all kinds of different angel investors. Even individual angels are listed in Crunchbase. It's a treasure trove of information about people who are currently investing. There's a lot of other databases out there. You start Googling, you know, how do I raise capital? You're going to get a bunch of them. Some of them are paid, some of them are free. I just got an email today from some guy that said, hey, I found you on the free RAMP database. Because I get, I don't know, at least 5, 6, 10 emails a day from somebody raising capital. And they're finding me and my funds on a variety of databases. What they're not doing, though, is they're not doing their research to figure out, oh, I've got a crypto thing that I want you to invest in. Well, I'm not a crypto investor. It's pretty clear from my profile and all the work I do that I'm not saying that's a bad investment for others. I don't know anything about it. I choose not to do that. So they've not done any research. They're just spamming out. They're finding my name, spamming me with these things. And my answer to all of them is, thanks for sending me your company information. Here's a link to here's our process. If you'd like to apply after reading this, here's where you go. So if you go to Crunchbase, there's these other databases that you can do, but I would also advise, if you're following this route, find out who the people are behind it. You can find that on a Crunchbase and some of these other databases. Look the person up on LinkedIn, look up their company on LinkedIn, try to figure out what is it that these companies invest in. Are they pre-seed investors? Are they seed investors? Are they A-round investors? Do they invest in crypto? It's usually pretty obvious from their profile on Crunchbase and in other places what kinds of investments they make, how big their investments are.
Jeff, thank you. We do have a question from here actually in the room.
So Kenny's question was, is it worth the money? I thought it was like $300, but Kenny's telling me now it's $600, but I still think if you're trying to raise hundreds of thousands or millions of dollars, spending $500 a year to get the information is not a bad thing. And it's got a good reputation. That's interesting. We'll put that in the parking lot. Kenny asked, is there a way to learn it? There might be some YouTube videos. I don't know. I'll check. But we use the heck out of Crunch. Our primary tools for research in our company on the investment side are Crunchbase and PitchBook. We do Statista and a couple other databases that are more general market research. But from a venture capital perspective, Crunchbase and PitchBook are two go-tos because they tell you a lot about the company. if you are going to, well, PitchBook, I can tell you get ready. It's going to take your breath away. The subscription for PitchBook is $30,000 a year. Usually that's sold to VC firms, even large VC firms that are investing, tens, if not hundreds of millions of dollars a year, where you can justify spending that kind of money. The information in that database is gold. It's great, but it's pricey. So if you do have a friend or somebody that can look up a few things for you on PitchBook, that can come in handy. You don't want to be bothering them all the time to look up this and look up that. Unfortunately, there are a lot of databases that are available through the business librarians at UNLV and UNR, and they don't subscribe to PitchBook. They subscribe to Statista and a bunch of other databases. But as Nevadans, since our universities are land grant universities, we as Nevadans get to use those resources. And most of the time, the business librarians will help you. They're not going to do the work for you. There's a really good person here in Las Vegas, Patrick Griffiths, Griffis. Patrick is amazing. And he's super helpful. And Kenny's Gillen, yeah. So he's a good guy and knows his stuff, but just don't come to him unorganized or expect him to actually do your work. Yeah, once you're logged, once you're on their network, you can actually access the database. It's a big thing that we have in Nevada. I don't know whether other states have anything like this, but it's a big deal to be able to get on some of these databases that cost tens or hundreds of thousands of dollars per year. The information in them is rich, and it's good. It's really good. Two other places to look. There's a tool out there called VC Rank. You can Google it, look it up. It's put out by a venture capital firm out of Chicago called New Stack. Nick Moran does a podcast called The Full Ratchet, and it is filled with little tidbits of information as a founder. He regularly has different venture capitalists on there and talks to them about how they think about investments, different kinds of investments, different parts of the economy where they invest. So you learn about people on the podcasts, and he has on there regularly people that like VC's debriefing, like, why did I pass on this? I think that's what the segment's called, Why I Passed. So VC Rank, you are giving your name up when you go into their tool. You are saying, hey, I'm looking for money. Here's my name. Here's my company. Here's my email. You give them all your requirements. What stage are you at? How much money are you raising? They'll give you back a list that's specific to you. I think it comes in Airtable, so you don't get to keep it, but you can look at it of the venture capitalists out there that fit your profile. Are you a CPG company? Are you a business-to-business SaaS company? Are you a crypto company? Are you an AI company? Whatever it is, you put it all in, and they give you a suspect list of who they think are writing checks right now, and who they aren't, who aren't writing checks right now. So that's another really good place to go looking for venture capitalists. There's a couple of platforms out there: Deal Room, Gust, AngelList. Carta has some good information out there on it. Doesn't usually have a list of VCs, but there's a lot of good information out there on Carta. And Logan's got his hand up.
We do. We have a question from online from Christian. Thanks for sharing your insights, Jeff. I'm curious, what is the approximate percentage allocation across different sectors, fintech, consumer logistics, AI, et cetera, for your angel funds versus your startup funds? I.e., does focus shift as you move to earlier stage companies?
So I wouldn't say that it's necessarily if you have a generalist fund, then they'll be paying attention to their mix in different industries. But a lot of funds are specialists. Like we're a generalist fund, although we have things we like and don't like. And if you go on our website, you find out exactly what we like and what we don't like. And most funds do the same thing, because we don't know, most of the funds don't want to waste everybody's time. If I'm a fund that only invests in B2B SaaS, you come with a CPG company, you're wasting your time, you're wasting our time. So there are funds at every stage that do I'll say specialize in a type of company or a type of industry that they might invest in. Small funds like ours, It's hard for us to do CPG because the investment is so high. Pharma, biotech, the deep science kind of things. It's hard for a small fund to do that. You better, if you've got that kind of a thing, you better be looking for a big fund, even at an early stage. If you're in the B2B SaaS market, hey, we'd love to hear from you. I mean, that's kind of one of our sweet spots that we do, although we do look at lots of different things. So hopefully that gives you some clues as to.
Yeah, Christian, feel free to elucidate on that or ask follow-up questions if you have any more. But Jeff, back to you.
Yeah. So, and the same is true for Christian's question could apply just as well to angel groups. Angel groups tend to like certain deals. It's not quite as obvious. You can go on Angel Capital Association's website, and they'll list all their members. They're all over the country. There's hundreds of angel groups. I'm leading one in here in Nevada called the Sierra Angels. Our group tends to like, there's a curiosity around medical things because we have a few doctors in the group. So they like that. They like they're curious about the possible breakthroughs in medicine. They don't always like the valuations, and they don't always like the length of time it takes to have an investment pay off. But there's a curiosity in our group about medical, med tech, things like that, along with B2B SaaS and some other more capital efficient kinds of startups. But if you can glean the personality, sometimes it's right in their name. That the angel group's names, a lot of times it's a regional name for their geography, but a lot of times it actually says exactly what it is that they like to invest in. So check out Angel Capital Association. The angel groups, the larger ones, you might get $1 million, $1 million to $2 million out of an angel group. That's sort of on the large size of an angel group investment. Usually the individual angels, the individual members of the angel group are writing their own check to your company. So if you're a founder and you're raising a lot of money from angels, you could get yourself into a messy cap table situation. Some of the angel groups are happy to pile into an SPV. Others don't like it because the angels want their name or their trust name on the cap table. But angels are a good source of not only money, but connections and genuine coaching. Because if you're a group of B2B SaaS angels, you are doing this not just because of your investment, but you want to help. So that very early stage angel pre-seed area is a really rich place to get some of your first investments. And then the site CB Insights has just a ton of information. And another site I don't have on here, it's called DocSend. I think they were just acquired by Dropbox, but it's a way that you can put your deal room when people are doing due diligence on you. You want to have all your documents, everything there. You put them on DocSend, and you as a founder get to see, did they look at my documents? Did they look at my pitch deck? How many minutes did they spend on each slide of my pitch deck? And because they track all of that for you, they also have a lot of rich information about who's investing, who's actually writing checks right now in what time. So if you're actually looking for more ways to find new groups, new angels, new investors, there's a lot of research that DocSend puts out there to the entrepreneurial community. So because they want you to put your stuff on their platform. And it's not cheap to have an account at DocSend or Carta. But as you get further up the stack in terms of raising money, it tends to make more sense to use an outfit like Carta or DocSend to keep track of your cap table and to put your deal room out there. Because, if you're raising $50,000 or $100,000, you probably don't need to know how much time they're spending on the third slide in your deck. But if you're raising a couple of million, it's good to know that these emails that you're sending out, did they actually click on the link? Did they go and look at your deck? How much time did they spend on each thing? It's really fascinating information, but don't go too deep down the rabbit hole because you can spend hours on that stuff. You gotta make sure your time is super valuable. So how you do this stuff, you gotta know how much you're raising and match that with the stage of each of these things. And we talked a little bit about all of those things already, but know that you're a pre-seed, know that you're an angel, know that you're raising at the A level by how much you're raising and what your valuations are. Do the research. Find the companies that make sense for you. Find the venture capitalists and angels that make sense for you to pitch to. You're wasting everybody's time if you're just spamming them out there, and it doesn't help you. you have to be willing to put yourself out there and have some thick skin and take a no, but do some research, make sure you're in the right phase, that they're actually writing checks right now, that they're not in a pause or something else. And understand their process. Everybody's got a little bit of a different process. You know, we like you to fill out an application and send us a pitch deck first. Some people like that. Some people are fine with you just emailing them a pitch deck. But whatever the process is for the people you're approaching, understand what it is. Take some time you're asking them for money, understand how they want you to ask them and follow that. Some stats, you're probably going to make 50 contacts to get a meeting. And then you're going to have 50 meetings to get an investment. It's a grind, which is why those 2 pictures that you saw on that first slide look the way that they do. It's a real grind, and get used to hearing a lot of no's. Don't take it personally. Just take whatever feedback you can get and move on. And you know, be gracious the entire time, because nobody likes a sore loser. So questions. I know it might take a minute for people to start asking questions, so I seeded it with a few questions I hear all the time. So I'm going to start running down my list until more people start piping in with questions. Is equity investing the best way to raise capital? It's not the cheapest way to raise capital. If you can get debt, that will ultimately cost you less money when you compare what you've given up for the amount of money you paid for it. What do VCs and angels really want? They want a company that's got a huge market, a huge TAM and a huge SAM that's probably a little undervalued, so that they can make at least a 20x to 30x, hopefully a 50x return. So for every dollar they put in, they want to be able to count on getting $25, $30, $40 back. And the reason that they do that is they know that out of every group of 20 companies, 15 of them are going to fail. They're going to go to zero. 3 or 4 are going to return the money maybe a little bit more than what was invested. 1 or 2 are going to hit that number, and it's going to pay for that whole group. And that whole group needs to make 3 to 4x. In order for that whole group to make 3 to 4x, you got to have every one of them be possible to get to 40 or 50x when you do the math. So that's just really what angels want. Go for it.
Well, you have one again from Christian online. Understanding that markets cycle from being more founder-friendly or investor-friendly environments with respect to term sheets. In this current tighter capital raising environment, what are you seeing or what do you think are fair terms to agree to at a pre-seed seed stage Series A? 1x or 2x liquidation preference or anti-dilution protections that founders should consider appropriate. Yeah, there's a whole series on this and another programs. But
yeah, there is. So we do have some YouTube videos that go deep on that particular topic. I'll try to be brief on it. So, you know, a 1x liquidation preference on a price round is completely reasonable. You start to get in 1.5 or 2 or more. That gets a little sharky even in this kind of environment. There are people who do it, and there are founders who will agree to it. It's not a horrible thing, but if you've got so just proceed with caution. I'm still not seeing a lot of 2x preferences out there. Everybody's still pretty much sticking to the 1x on the price rounds. And the valuation is really where you can either make or break your deal. So, you know, I'll go to one, you know, is there a right valuation or valuation cap for my startup? You know, we're putting a tool out there in much the same way the guys in Chicago have their tool to find venture capitalists. You will see soon on our website a tool to figure out, do I have the right valuation, or how do venture capitalists think about this? But the thing you have to think about is, are you in a market that is big enough that when you get acquired, that the investor can make back that 30x? Is that reasonable? And then what are the multiples in there? It's like, okay, so I'm coming in at a $5 million valuation. That means that they need to make 5 times 50, $250 million, $250 million on that. So that means if I'm going to get a 4x valuation at the time of acquisition, then I got to have $1 billion in value to get that money out. And how much sales do I have to get to make that happen? So do some of that mental math in terms of how will the investor make that 20x, and then back into your whether your valuation is reasonable or not from there. look for a calculator from us. We have it in a spreadsheet form right now, but it'll be on the website soon so that you can tweak it, play it, and that'll get you to a valuation that makes sense for the for the investor. And you may or may not want to do that. You may think that's crazy. I'm not giving them that $5 million valuation. I'm worth way more than that. I might get diluted too much. So I wouldn't get as focused on being diluted because 100% of zero is zero. 5% of $1 billion is a lot. So
we have a question from Dustin. We have a biopharma startup, novel compounds, and want local investors, but this industry is clearly not represented in Nevada currently. Any tips to find locals for this industry?
That's a hard question. I wish I had a back pocket, black book with all the names of the different investors here that would support any given industry. You're gonna have to do some research. You're gonna have to get after the databases, some of which I mentioned, to see who's investing in what and if anybody's here. Crunchbase does have some individual angels in it. And that may be a source for you. I'm not familiar with that specific niche myself, or I would share the names. But if I was in your shoes, that's how I would go about looking. I would go to the VC rank tool. I would go to Crunchbase. I would go to DocSend. They have the ability to search on all of those things in them. Whether or not they're here, I don't know. Don't know. Okay, so should you cold email or approach angels? Well, I've told you what my experience is. I don't mind if somebody's if they've read and they say, hey, I'm from Nevada, I've got B2B SaaS. I'm not sure why we haven't met, but I'd like to engage. Love that cold email. Doesn't happen very often. But when I get somebody from Africa with a crypto Web3 thing, it's like you guys didn't pay any attention to what we do. And I'm professional in my response, but it's not going anywhere. And it just clogs up my inbox. So most of us who are in the venture game feel the same way. We'd like to be introduced by someone we know who knows you. That's the best. But if you that's not always going to be able to happen. So as you're searching for places that you want to go, see if there's anybody in your network on LinkedIn that knows this person, that's connected to him. Ask for an intro. It's always better to be introduced than to go cold. But don't be afraid to go cold if that's your only choice. But just make sure you have some chance of landing with this person. If you're a CPG guy and they're a pharma group, well, chances of that happening are low, and everybody's just going to be annoyed. So how do accelerators and incubators work? There's two different sort of schools in this area. The school that Startup MD follows is the pickers school, which means that we don't make a ton of investments. So we have to pick the right people. And we make our deals one by one. Your company might have a different valuation than your company because of the industry that you're in or whatever is going, for whatever reason in your particular circumstance. The big guys, the Techstars, the generators, the 500 startups, there's a lot of them. They play the numbers game. And there is a mathematical thesis. The reason 500 startups is named 500 startups is as you invest in more startups, your chance of having a zero return go almost to zero once you get beyond about 25 startups. And the further you get out there, the closer it gets to zero. And these are chances of having a 3x return on the group of startups that you're investing in, which is the minimum for a venture capitalist. And the reason the minimum is 3x is if you invest your money in the stock market over the last 100 years, the stock market has returned a little over 7% a year, which means your money is going to double every 10 years. Over that same period of time, taking all the risk you're taking with venture capital, you better get 3x at least, or it's just not worth it. So that's why you hear that 3x to 4x for these funds, is because you better be doubling up what you can do in a much safer startup or much safer public investment. So that graph, losing money looks like a curve that goes, from left to right and goes steeply down and then almost flattens out near zero once you get beyond about 25 startups. Going the other way, chances of actually getting a 3 to 4x return, the curve's pretty steep from left to right till you get to about 25 startups. Then it flattens out a little bit, stays kind of the same at, at about a 70% chance between 25 and about 60 or 70 startups in your group. Then it starts to climb again. When you get to about 500, guess what? Your chances of getting a 3x return go to about 90%. That's why these guys with big piles of money spread the cash around. Now, you got to pay attention to their terms, though, because you will find that Techstars, Generator, a lot of, not YC, they're in a different category, but a lot of the big guys will say, hey, we're going to invest $100,000. The first $20,000 is for 5 or 6% of your company, and then the rest is in a note of some kind, either a safe or a note. That first, pay attention to that first little bit, $20,000 for 6%. You just value your company at $333,000. If you have other notes out there that convert, when you have a priced round, they'll convert at that lower valuation. You can wipe yourself out. So pay attention to those notes. See if they're going to have an impact on you. It's up to you whether you decide whether or not you want to take that money on those terms and conditions. I'm not a fan. If I see somebody's gone through Techstars or Generator, I say, well, I want those terms too. And it just puts you in a really defensive position for anybody who comes behind them. So they're a lot of good. They do a lot of good. They bring in a lot of companies that might otherwise not get into another program. You can learn a lot of them, but there is a price to pay, and just be aware of it. Be aware of what it is. So,
all right.
Other questions? So the question was, if you fail at crowdfunding, does that hurt your chances down the road with other places? It depends a little bit. But it's not necessarily, it's a wound. It's probably not a fatal wound if you just shouldn't have been there in the first place. People will forget that history will go away. You shouldn't ever try to hide it because it is all discoverable. But yeah, I mean, it's not a forever wound, but it is going to be a wound for the short term, and you will have to continue to explain it every time that you meet with somebody new if they find it. A couple of years goes by. Somebody asks, you answer, but you don't need to bring it up. So, but just kind of keep in mind, see who's raised money. Like I said, it's better for the sort of consumer-facing kinds of things, rather than the sort of esoteric software, scientific things that it's harder for everyday people to get their minds wrapped around.
Jeff, again, really appreciate your time. And as always, it's always great when we can get one of the founders to kind of talk to the organization. So appreciate that.
Thank you.
Everyone, thank you guys for tuning in person and online for this session. Our next, the recording for this will actually be made available by Sunday, and also on the Founder University online portal, which all of you as registrants of this boot camp have access to, or you can get access to our organization. So if you have not gotten access to our online portal for Founder University, let us know, or let Audrey or Cara know, and we'll get you that. Next week, on August 10th, we will hear from Doug Harrison on finding a fundraising mentor. So it's another great series.
Doug's great. Doug's great.
Yeah.
Especially if you like Irish accents.
So everyone tune in. Also, remember, anyone who is registered having attended at least 70% of these sessions, we will help you build out your deal room. Jeff mentioned DocSend. Now, DocSend is one of the components, can be a tool you use for a component of your deal room. Your deal room is aggregated and deliverable information to any investor that is considering your startup. Very, very important if you're raising capital. So we're happy to help you set that up as long as you have a good attendance in these series. Other than that, Jeff, anything else?
I'm going to close on two questions that I didn't answer. Do I have to be a C Corp? Yes. Should I ask for an NDA before I pitch? No. There's more to it than that, but that's all we have time for.
We can definitely talk about that more. Anyway, everyone, thank you so much for joining us. We will see you all next week.